Good afternoon, everyone, and thank you for joining us. I am Jasmine Yu, Chief Investment Officer. Welcome to After the Surge, Investing for What Comes Next, the 2026 Economic and Market Outlook Live webinar. Despite periods of volatility, 2025 produced solid returns across US and international markets, spanning both equities and fixed income. At Burnmore Trust Advisors, our investment results not only reflected that strength, but also affirm the value of our investment principles and disciplined process. As we begin 2026, the key question is, how returns are likely to be generated from here? Today's conversation is focused on what comes next. Global economic growth stays resilient. Although the US labor markets have cooled, consumer spending remains steady, and corporate fundamentals are broadly sound. Markets are pricing in continued interest rate cuts, and leadership is beginning to broaden beyond the most crowded trades of the past several years. We'll talk through macro backdrop, equity and fixed income opportunities, the evolving role of alternatives, and most importantly, how we're translating our views into practical, goals-based portfolio construction. I am joined by my investment leadership team here: Andrew Davis, Director of Macroeconomic Research; Jim Barnes, Director of Fixed Income; Seth Datz, Director of Securities Research; and Ivan Shabalov, Director of Alternative Investments. Now, let's start with the big picture. So, Andrew, you mentioned on the recent To The Point broadcast that growth is normalizing, not breaking. What does normalization actually look like in 2026? And why is that distinction so important for investors?
So when I say growth is normalizing, what we really mean is the economy is cooling from this unusually strong period. It's not falling apart. So cooling, not falling apart. And so what did we have? Kind of coming out of COVID, we had, extraordinary surge driven by reopening, stimulus, maybe some overhiring, all that pent-up demand, you name it. Now what we're seeing is kind of this transition back towards something I would call more typical, kind of that pre-COVID environment. Slower, still positive growth, easing inflation back towards the Fed target, and a labor market that's, bending, not breaking, kind of loosening without collapsing. And so that normalization, that's a key distinction. It matters for investors because markets are going to behave very differently in slowdowns versus recessions. If growth's breaking, you want to play defense quickly. If growth is normalizing, kind of this cool down, the risk is really reacting too aggressively to the noise and the inability to separate the noise from the signal. And I think 2025 kind of reopened our eyes to that point exactly. There was a lot of noise, but lo and behold, the market and the economy, the macro, still remained constructive. And I think that's an important caveat to make here because most of the time, the market kind of lives in expansion. And, recessions are really the exception. They only happen like 18% of the time. Looking at the historical data, most of the time in kind of capitalist economy, earnings grow, economies expand, markets compound. So for 2026, our base case is just that cooling expansion, not an economic stall.
And you show growth and inflation for major countries on the slide. What would have to change in the global growth and inflation picture to materially alter your outlook?
Yeah, so this slide's helpful because it shows divergence, not distress, in my opinion. And so, you can see the growth rates across the globe. To materially change that outlook, probably one of two things, either inflation or growth. So on the inflation side, what would cause us to maybe revise our forecasts and ultimately make portfolio decisions would likely be a risk of reacceleration in inflation, one that maybe forces central banks to go into restrictive territory longer than the market expects. On the growth side, it would be one of those kind of stereotypical shocks, like a synchronized global growth shock. And there, the key distinction, Jasmine, is that it really needs to affect all three areas at once. Kind of global growth slowdown that's affecting financial conditions, consumer behavior, and ultimately kind of playing through the market. But right now we see pockets of weakness and pockets of strength. So that's very different than a global recessionary playbook or setup where we want to get defensive. Right now we're still seeing that slowdown, not breakdown.
Good. On the next slide, you show a very nice picture of the K-shaped economy. Can you explain the so-called K-shaped economy and how does the K-shaped nature of today's economy affect your confidence in the durability of the current economic expansion?
Yeah, so look, the K-shaped economy just means different parts of the economy are experiencing the cycle very differently. And I'm sure we're all living that in our lives. It's kind of two separate worlds, right? You have your high income households, those are your asset owners, they're the upper leg of the K, if you will. And they're feeling the wealth effects, right? So they continue to spend. The wage growth is healthy. They're not getting on, they're not looking at layoffs, anything of that nature. But on the other half, kind of the other half of the K, you have the lower, and to be honest, a good chunk of the middle income households that are facing, more pressure from inflation, still dealing with higher rates and affordability, whether it's housing or other areas of the economy. So that's why the data can look fine on average, and the aggregate is important to look at. But the lived experience can kind of feel uneven, and I think that's a nuance that us as economists, us as forecasters, us as capital allocators are constantly discussing and trying to discern and separate just that signal from noise. Yeah, and as far as the durability, it's a tension we watch closely. It's kind of give and take, right? The resilience at the top, it can continue to extend an expansion, but it's important to note at the same time there's risk there. Like the top 10-20% alone doesn't drive an economy. It can for a little while, but it doesn't drive it for very long. So the middle matters, right? Because consumption's still a growth engine in the US. Consumption makes up the majority of GDP growth, economic growth. So far, our forecast, what we're seeing is really just moderation, not a collapse. The weakness really hasn't cascaded broadly. And taking a step back, the K-shaped economy is kind of what already was existing and in play pre-COVID. The two poles maybe have widened a little bit, but I think that the distinction's important and why we say kind of normalization, like a slow growth environment back to pre-COVID. Yeah, so obviously that'll have investment implications.
Great. And on to the next slide, you show inflation expectations remain anchored. We talked about the labor market softening. How important are other factors like demographics, productivity, and AI investment in keeping the economy on stable footing?
Yeah, they matter a lot, and I think that's the real nuance of this cycle. I think you can't simply pull out your past recessionary playbook and kind of look at a checklist and say, okay, we're walking into a recession. And I think demographics is the big one because it puts a floor on their employment. And the working age population, it's growing more slowly, which means, and we've been saying this for a while, job growth doesn't need to be as strong, right? And so these month over month job gains that are getting reported and picked up in the news as being very weak or just kind of muddling through, right now that's fine because the supply of employment has come down a little bit. We've said it a ton, but you have the baby boomer cohort that continues to age day by day. I think every day, 11,000, estimating about 11,000 new baby boomers reach retirement. And so you have both supply issues and demand issues at play here. And so the equilibrium's kind of shifting is the way I think about it. Now, what that means for productivity and AI in particular is I think that's all, they're all interconnected. They're all related because businesses are smart enough to look at their labor force and say, okay, we have these aging demographics. We need to figure out how we should be deploying capital in this environment to get more out of less workers, a la productivity. And so productivity continues to surprise to the upside as firms are doing just that, right? They're doing more with less or more with the same amount of workers without having to lay off, but they're getting some aging out of their business. And so, yeah, the AI investment's real. We've said it a ton, like all companies are asking, how do we deploy it, not whether they should. So whether it's automation, infrastructure, whatnot, I think that the AI investment doesn't eliminate risk, but it does help explain why slower hiring and these productivity tailwinds hasn't translated into mass layoffs, which you would, normally call for or maybe normally look for if you didn't have supply side demographics shifting around.
Yeah. How about geopolitics? A question we got asked by advisors and clients a lot lately. How do geopolitical developments, including the recent high-profile events involving Venezuela, factor into your macro outlook?
Yeah, so we treat geopolitics as a risk manager, not really a forecasting tool, right? Geopolitical risk is omnipresent. The important thing for like our models and forecasting and putting capital to work, how are they impacting really three channels? Energy prices, supply chains, financial conditions. So really inflation and growth, back to that framework. So, the latest news on Venezuela matters primarily through that energy channel. That's what we're looking for, what are oil prices doing, and what are inflation expectations doing. Right now, as the chart shows, it's really illustrative. Inflation expectations are still well anchored. That tells us that market participants, they're you could say they're shrugging it off, but I think that the more important thing when they're forecasting, right, and they're putting capital to work, the broader point is that the market is looking for, okay, are the rules of the game changing? Are stability changing? And how should we be discounting? How should we be thinking about the environment? And right now, what it's telling me is, at least in the near term, the market is saying that, they're looking at this more as noise than signal. But I think the broader point, diversification is going to matter. Geopolitical risks bubble up from time to time. And so that's always something that we want to hang our hat on. But yeah, taking a step back, look, I think growth slowing for 2026, that's our forecast, but it's doing so from a position of strength. And so what we really want to watch for is just signs that weakness is spreading, and particularly labor market consumption. But make no mistake, base case still remains this normalization, just not growing gangbusters like we were kind of that surge after COVID.
All right. Thanks, Andrew. Thanks for now. We'll be back to you later in the webinar. Let's move on to the fixed income section. Jim, after a very strong year for fixed income, markets appear increasingly confident that the Fed is approaching more rate cuts in 2026. What are markets getting right, and where might expectations be vulnerable? And how important is central bank independence in the whole process?
Great. Thank you, Jasmine. Well, so we've been in a rate cutting cycle now. I mean, going back as far as towards the end of 2024. At that point, the Federal Reserve had dropped interest rates by about 100 basis points or so. And then towards the end of 2025, they dropped the federal funds target range again by 75 basis points. So we've had a lot of easing over the past, a little north of a year or so. And that's been reflected, to your point, within the fixed income markets. 2025 was a pretty strong year across all fixed income sectors. You had the short end of the yield curve. When I look at U.S. Treasuries, the 2-year Treasury maturity, it's very sensitive to monetary policy. That was down about 70 basis points in yield, ended the year around 3.5%. The 10-year Treasury yield was down about 40 basis points or so, ended the year about 4.15%. So with yields coming down, prices going up, that was a nice contribution to just overall return. And then you also have to take in consideration the fact that you started the year at pretty healthy yield levels. So now when we take a look at 2026, we do think that you probably have another 2 more rate cuts that's in there. And a lot of that simply just has to do with, the fact that we're sitting here with policy rates that we would say are still somewhat restrictive, 3.5 to 3.75%. In our view, that's still somewhat of a restrictive level. Should weigh on economic growth to some extent, should weigh on inflation. And so you have a little bit of a cushion there. So with rates coming down, in our view, that should work into another year of Treasury yields heading lower. Now, with all that being said, so now we have to think to ourselves, well, taking a step back, well, what can go wrong? If you have inflation that comes in stickier than what we're anticipating, instead of going down to 2.5%, maybe it lingers a little higher than that. Well, that could cause a rate cut to be taken off the table and put upward pressure on Treasury yields, something that we're not expecting, but we have to just be aware of a scenario such as that. And then the flip side to that as well, if you think about the labor market, the 75 basis points of rate cuts that we got towards the end of the year, a lot of that simply had to do with what was happening within the labor market, some weakness there. And so if the labor market it doesn't hold up and you end up with a little more weakness than what we're anticipating, I mean, that could require some additional rate cuts than what we're anticipating, and that could put some additional pressure on yields going lower. So those are some of the things that we're paying attention to. But overall, base case, we think 2 rate cuts in 2026 makes sense. And we think, at least for the intermediate part of the Treasury curve, it should be able to benefit for another year of decreasing bond yields.
Yeah. And how about central bank independence, which has been a topic that has raised a lot of interest lately?
Yeah, so it's a very important question. It has gotten a lot of news around it, but I would say it's more news. I mean, the credibility of central banks around the globe is just extremely important. And just real quick, taking it back, a quick walk back to history. I mean, if you think back to the Volcker days, the chairman of the Federal Reserve at the end of the 70s and most of the 80s. I mean, he was able to conquer inflation and inflation expectations by raising rates. And he was really the pioneer of building that credibility around central bank policy. Then you had Greenspan, Bernanke, Yellen, and now Chairman Powell. And so that credibility about trying to control inflation and inflation expectations is key. You saw from that prior slide how well anchored inflation expectations have been over the years. And it's interesting, even after COVID, when actual inflation was running 5, 6, 7%, inflation expectations still remain somewhat well anchored, and that's well anchored closer to 2%. And that's key, because generally speaking, actual inflation tends to head towards wherever expectations are. And that's because investors have built this credibility around the Federal Reserve, knowing that if inflation is stubborn, the Fed's going to be there to react by raising policy rates, keeping them somewhat restrictive until that inflation comes down. If that credibility starts to get lost or compromised, that's where you would notably see that in your inflation expectations. We haven't seen that yet, so that's where it goes back to what I was saying before. Hopefully, right now it's just more noise. Interesting to take a look at. But the credibility of the Federal Reserve is a very powerful institution. And breaking that at this point, it doesn't seem realistic. It's more noise in our view.
All right. Thanks, Jim. After talking about the big picture of rates, let's talk about how we're actually positioning fixed income portfolios. So in particular, right, balancing reinvestment risk versus duration risk in a world where rates may gradually move lower, but not collapsing. How should we be doing that fine tuning, fine balancing within our portfolios, Jim?
Yeah, so in our view, we do think, as we said, that the yields are going to head lower in 2026. We just have to be sensitive and balance. In fixed income, you think about two primary risks: the reinvestment risk and your duration risk. And so, even though we do think that the yields are going to head lower this year, that doesn't mean we're going to go out there and buy and load up 100% of the portfolios on 30-year maturities and lock in those yields. There is some advantage to doing that if yields go down, but you just have to be sensitive to the idea that there could be a scenario where yields stay elevated. When you think about deficits and outstanding treasury debt, I mean, that could be a factor that's spooked markets in the past, and that can happen again this year. And so we don't want to put everything out there long term. Balancing, having some funds up short in case short-term rates stay elevated more so than what we're anticipating. At least then you always have some fresh powder. And then the flip side to that, having some funds invest a little bit longer yields, with the thinking that, for expectations for lower yields down the road do pan out, at least you've locked in today's yields, which would be beneficial to the clients.
Great. How about credit markets? Credit spreads remained relatively tight despite rising concerns. Where do you see opportunity, and where does caution make sense?
Yeah, so we still like credit, investment grade credit. We like high yield credit. I think, when you think about an economy that's slowing but not breaking, having exposure in those areas makes sense just because you're getting that additional yield compensation above the treasury curve. It's just that the we want to point out, and this is very important, is that that additional yield that you're getting above treasuries keeps getting smaller and smaller. So you're not necessarily being compensated potentially if you were to have some adverse, market impact. So with this in mind, we do like having exposure there for diversification purposes. We just think there may be a better opportunity to potentially add on to investment grade corporate bonds or to high yield when the opportunities present themselves. So when we think about bond portfolios, if it's investment grade focused, maybe going into top tier investment grade or maybe even to U.S. governments to us makes sense. Or if you do have the risk tolerance for high yield exposure as well, maybe just from a tactical standpoint, a little bit lower than where your strategic focus is. And then again, just looking for that opportunity within the marketplace when it presents itself to add on then, depending on what the context is at that moment.
Great. How about outlook for municipal bond markets?
Yeah, so municipal bond market, I mean, it's just fixed income in general. I mean, yields have been coming down, but the absolute yield is still pretty compelling. And so within the municipal bond area, that theme is obviously very consistent. I think when I think about the municipal area, from a credit standpoint, fundamental standpoint, reserves are still very strong. Balance sheets are still very healthy, so that's a positive. I would say right now valuations might be a little stretched, which is somewhat normal at the beginning of the year. But those absolute levels within an environment that, where we're thinking that yields can head lower, it remains somewhat of a compelling environment for the municipal area as well. Credits that continue to be very strong and absolute yields that remain compelling.
Yeah. And how does international fixed income fit into a diversified fixed income portfolio? As we mentioned in the beginning, that global monetary policy paths diverge.
Yeah, so when I think about the international markets, the international developed markets, because we've had exposure to EM, which was a very, very strong performer in 2025, double-digit return. So we have outside the U.S. exposure to the international markets. The developed markets really started to float more to the surface after COVID, when you just had a repricing of global bond yields all around, which was a very positive for fixed income diversification purposes. I think when you think about the international markets today now, and you think about central bank policy, we tend to focus more on the U.S. In the U.S., the Federal Reserve has been in a rate cutting type regime. If I think about Europe and the European Central Bank, they seem to be on hold. If I think about the Bank of Japan, Their bond yields have been going up. They've been increasing their policy rates. And so the takeaway there is that there definitely is some divergency, the disparity from where something as powerful as just central bank policy is, that there's definitely some opportunities within the fixed income markets when you think about it on the international front, just from trying to diversify. When one area is zigging, the other areas might zagging. And so that's something that we have been contemplating to see what areas we think makes the most sense.
Great. Thanks, Jim. Let's move on to equities and let's go to SEP. Looking at market history, this appears to be the fourth year of the current bull market. How does this phase typically differ from the early years of a cycle?
Okay, that's a great question. So if you look at the market history chart here, it lines up the past bull markets by the year of the cycle, and it also shows the typical range of S&P 500 returns. So the red circle marks where we are today, and that's in year 4, with about a 5% gain since last October. But set aside that exact return number. What matters, Jasmine, is the pattern of how markets behave at this stage. So stepping back, in years 1 and 2, markets are usually strongest because you're coming off a downturn. Confidence improves, valuations rise, the gains feel broad. A lot of stocks go up together. But by year 4, the market tends to change. Returns can still be positive, but they're usually more modest and more uneven. So instead of the valuations doing the heavy lifting, the results can depend more on the fundamentals. So the market focuses more on companies that can demonstrate sustainable earnings and cash flow generation. So also on the chart, if you'll notice, the year 4 outcomes are more spread out. Some cycles are strong, others are choppier. And that's because it becomes a much more selective market. It rewards sustainable growth, strong balance sheets, and pricing power, and it's less forgiving of weaker businesses. And importantly, volatility is normal in this phase. So you do have pullbacks, you have shifts in leadership, corrections often happen. It's not necessarily as a warning sign, but as part of how markets reset and keep moving. So the key takeaway here is simple. Early in a bull market, being invested is often enough. But by year 4, the success depends more on what you own. And so as Andrew mentioned earlier, you want to stay diversified. Additionally, you want to lean into quality and be prepared for a few bumps along the way.
Great. On this next slide, we also show that historically equity markets have performed well following Fed's rate cuts. So what matters more going forward, the direction of rates or the pace of earnings growth? I know you mentioned fundamentals in the beginning. What is your view on rate cuts versus earnings?
Yeah, so historically, stocks do well after the Fed begins cutting rates. But Jasmine, the real question is what's driving those cuts and whether they're meant to prevent a slowdown or respond to one. Rate cuts tend to help most when they prevent a slowdown or when they support a rebound in corporate profits. But looking ahead and thinking about the fundamentals you mentioned, we think earnings growth will matter more than the direction of rates. So rates may come down from today's levels, but it's unlikely that we return to the near zero environment that boosted stock valuations for much of the decade after the financial crisis. So rate cuts alone may not be enough to drive big gains. From here, the market will care more about the fundamentals and put the spotlight on companies that can grow profits, protect margins, and generate steady cash flow. So to recap, if earnings are rising, markets can do well, even if rates don't fall much.
Yep. AI, artificial intelligence, continues to dominate market narrative. At the same time, AI bubble concerns have become mainstream. What indicators are you watching most closely to distinguish healthy investment from excess? That's a tough
Yeah,
question on everybody's mind, I'm sure.
yeah. I mean, we hear it a lot. We hear the AI bubble comparison to the dot-com era. Um, I think our view is a little bit more balanced. We do see some AI-related valuations as clearly full, but unlike in the late 1990s, there's real usage and real revenue behind much of today's spending. Most of the companies we talk to and follow say they're capacity constrained and they're not demand constrained. And that's really an important difference. So we're not dismissing bubble risk, but we're watching demand, we're watching returns on investment and technological progress to distinguish healthy investment from the excess. So the real question is whether today's spending will earn an adequate return. So we're watching a few indicators to get to the heart of the economics. The first being demand for compute. So if AI is truly useful, usage should continue to rise. This means more workloads moving into production and steady demand for your GPU processor capacity. The second really revolves around unit economics and ROI, or return on investment. So the biggest spenders, and this includes Microsoft, Google, Meta, and Amazon, they need to continue to show that higher AI costs are translating into clear benefits. If costs rise but margins compress without a payoff, that's really a warning sign to us. The third thing is capital discipline. Okay, so healthy cycles keep spending tied to returns. Excess looks like growth at any cost. These are projects that are funded because everyone else is doing it, not because the math works. So we also watch debt-funded build-outs. And so far, we haven't seen leverage reach anything like during the dot-com fiber build-out era. And then finally, we monitor the progress of the largest AI models. So this includes ChatGPT, it's Claude, it's Gemini. If these models stop improving meaningfully or the cost of improvement rises sharply, that could reduce returns and slow the willingness to keep spending at the current pace. So those are the things that we're monitoring. And I think at this point we're looking at a lot of different areas, and we're not ignoring bubble risk, but we are just focusing on demand and returns on investment.
Got it, Seth. After years of US dominance, international equities began to reassert themselves last year. Is this a short-term rotation or a more durable trend? How should investors think about valuation discounts overseas versus the stronger earnings profile in the US?
Yeah, so after a long stretch of US leadership, it's noticeable that international stocks improved in 2025 and had really strong returns. The key question isn't whether they outperform every quarter from here. It's whether the setup really supports a more durable period of better relative returns. Our view is somewhere in between. We don't see it as a one-quarter trade, but it's also not a guarantee of a decade-long leadership shift. So, and there are a few reasons for this. Um, Valuations abroad are still meaningfully cheaper than in the US by most measures. In many countries, the earnings cycle is earlier, so there's room for improvement if the growth is sustainable. And then on top of that, you have currency and currency headwinds that hurt US-based investors in prior years have been less severe, and that can make foreign returns look better when converted back into US dollars. But it's also important to be clear about the US advantage. The US tends to have stronger and more consistent earnings growth, more exposure to innovation, especially technology, and generally higher profitability. And that's why US stocks have earned a premium. and we don't see that premium as likely to disappear anytime quickly. So we don't frame this really as an either or. We think of it as different strengths for each. So for the US, we have better earnings quality and structural growth. International, on the other hand, has lower starting valuations and possibly more upside if the fundamentals improve. But importantly, Jasmine, international doesn't have to beat the US on earnings to work. If global growth improves even modestly, simply closing that valuation gap can generate attractive returns. So summing up, we really view international equities as a strategic complement or an added source of diversification and potential return that can improve long-term outcomes without needing U.S. leadership to end.
Well said. Thank you, Seth. Okay, why don't we move on to the next segment, alternative investments. Here, there are two slides. The first one shows a lackluster year for private equity. And then the second slide actually highlights infrastructure as a major success story. So my question to Ivan, what drove the performance divergence here?
Thank you, Jasmine. So it's a great question. It's true that private equity infrastructure performed very differently in 2025. And that divergence was primarily driven by the impact of the high interest rates and the fundamental differences in their asset characteristics and valuation methods. Private equity's performance in 2025 was hampered primarily by several factors tied to the macroeconomic environment. First of all, high interest rates made debt financing a core component of private equity deal making significantly more expensive, and this reduced the number of transactions and squeezed returns. Many private equity firms had acquired companies at high valuations at pre-COVID, at pre-2022 era, and at low interest rates era. And in current market environment, sellers are reluctant to exit at market down values, creating a long jam of unsold assets and the longest holding period on record. And as a result, the lack of exit opportunities meant private equity firms struggled to return capital to their investors, which in turn slowed down fundraising for new funds. And the traditional private equity model relied heavily on using leverage and selling on higher valuation multiples. The current market environment demanded more hands-on operational approach to value creation, which not all firms are prepared for. Infrastructure, in contrast, thrived due to its inherent defensive characteristics and alignment with current economic tailwinds. Infrastructure assets like utilities, transportation, telecommunications provide essential, often government-regulated services with predictable, long-term contracted revenue streams. This stability makes them resilient during economic downturns and market volatility. Many infrastructure contracts include inflation-linked pricing, which help protect and even grow revenues during a period of high inflation, unlike many private equity portfolio companies which faced rising operational cost. Private infrastructure assets are not priced daily like public equities, which smooth out observed returns and insulates them from short-term market sentiment swings and affected other private equity markets. The sector benefited from massive investment drives related to deglobalization, electrification, and the demands of AI data centers, which require significant power and digital infrastructure development. And as limited partners, investors faced liquidity issues. They sought the stable income-generating characteristic of infrastructure, leading to significant increase in investor interest and capital allocation to the sector.
Okay. I know in addition to infrastructure, Ivan, you're also a big proponent for real assets. So what are real assets and why do they make sense in a portfolio at this stage of the cycle?
So, a good question. And they make sense now due to their inflation protection, diversification benefits, low correlation to stocks and bonds, stable, predictable income streams, often inflation linked, as I said before, in alignment too with long term secular trends like digitalization and energy transition. And they offer resilience in uncertain markets with elevated inflation and rates. So to summarize, the key reasons for including those assets in your portfolio are inflation hedge, so their value and revenues often linked to inflation, providing a buffer against rising prices, diversification. They typically have low correlation with traditional equities and bonds, reducing overall pricing volatility and portfolio volatility and improving risk-adjusted returns. A stable income, essential infrastructure often generates consistent cash flows through long-term contracts. Economic resilience, core infrastructure support fundamental economic activity, making it less sensitive to cyclical downturns in many other assets. And secular growth trends, they're positioned to benefit from powerful long-term shifts like decarbonization, digitalization, data centers and fiber, and urbanization. So in essence, at this stage with persistent inflation, higher rates, and economic uncertainty, real assets offer a blend of capital preservation, income, and growth potential that traditional assets struggle to match.
Got it. So if investors have to think about the broad alternative category, you mentioned private equity, infrastructure, real assets, but at the category level, how should investors think about alternatives, not only as portfolio stabilizers, but also as return enhancers?
Great question. So investors should think of alternatives not only as volatility dampeners, but return enhancers due to their ability to generate high, often uncorrelated returns by assessing unique opportunities not available in public markets, provided that they have a long-term horizon and tolerance for certain illiquidity. Uh, Access to inefficient markets. Alternatives often invest in private markets, private equity, venture capital, private credit, where information may be less efficiently priced than in public markets. This inefficiency allows good managers, to generate returns above the benchmark through active management, operational improvements, and specialized sourcing of deals. Illiquidity premium plays a big role. By committing capital for long periods, often 10 plus years in private equity, investors are compensated with an illiquidity premium, which historically has translated into higher long-term returns compared to liquid assets with similar risk profiles. Diverse return drivers. Unlike traditional portfolios heavily reliant on broad market movements, equity and bonds, betas, alternatives offer exposure to a wider range of return drivers, such as real estate appreciation yields, private company growth, or active hedge fund strategies, global macro event driven. And finally, lower correlation. While often discussed in terms of stabilization and lower volatility, the low correlation with traditional assets means alternatives can provide positive returns even when stocks and bonds are underperforming, thereby improving overall portfolio risk-adjusted returns. Uh, yeah.
Okay, thank you, Ivan. So you heard from our speakers, the final section is about how we put everything together, right? In the sense of portfolio construction. Burnmore Trust Advisors, we place a strong emphasis on goals-based investing, highlighted in last year's white paper, Smarter Wealth. So I want to ask Andrew, Why is this framework especially relevant in today's market environment?
Yeah, I think because the biggest risk in 2026 really isn't missing the perfect trade. It's making a big emotional decision at the wrong time. And I feel like investors always hear that, they're reminded of it time and time again. But when the environment is noisy, political uncertainty, rate uncertainty, like you name it, geopolitics, right? People really cling to like past performance or start chasing outcomes, like chasing what worked last year, chasing a story, chasing a trend, chasing a theme, right? Or maybe going to cash because it feels safe. So goals-based investing really just flips that because it's not necessarily anti-market. It's not like market unaware, but it's starting from a point of what's this money for? When do you need it? How much volatility can you leave with or live with rather? And because of that discipline, that like built-in discipline, we feel like it drives better outcomes.
Yep. So on this slide, we show a number of portfolio building blocks. How do they work together to manage uncertainty while still pursuing opportunity?
Yeah, so you heard all the speakers, how we're collectively collaborating, thinking about the environment, stress testing, and then understanding the key point. And Ivan hit on it a little bit there, it was sprinkled throughout the presentation, but how do these things interact with each other, called correlation? So really, kind of boiling it down high level, we think of high quality fixed income, that's kind of your stabilizer in the portfolio, liquidity engine, that sort of thing, sleep well at night money, if you will. Equities, that's where we're going to look for long-term growth engine, right? The compounding machine, compounding earnings, compounding returns. And then Ivan highlighted how like the use cases for alternatives or diversifiers. It's really like when correlations get weird, when things aren't co-moving the way you would expect, alternatives can really be worth its weight in gold. And then the last one, not to be forgotten, is cash, because although it's not a strategy, it definitely provides optionality. Like when we hold it intentionally and thinking about the risks in the environment, doing so in a calculated fashion. So the point is with all of this, with building the portfolios, constructing it, I think the mistake that people make is sometimes expecting it to be perfect. And we're not trying to predict perfection, but what we are trying to do is build the most efficient portfolio for your goal that can withstand multiple futures, withstand multiple shocks. And that's really how we drive better outcomes over time.
I see. So to be a bit more explicit, specific for investors feeling torn between staying cautious and staying invested, what does a balanced approach look like in 2026?
Yeah, so I think balance first, you don't want to confuse, we keep saying, or at least I do, normalizing. That doesn't mean no risk. We would expect volatility. We're seeing a little today. So it's not, markets don't move in straight lines. That's definitely not what we're saying. So expect more two-way markets. Second, I think keep your default posture disciplined. And that's really what we try to do. Because like I said, most of the time, the market lives in this growing, expanding economy. The recessions are the exception, not the base case. And so the periods that really punish investors and punish our clients would be those environments that are clustered around recessions. And that's why we're monitoring, okay, are recessionary signals starting to bubble up and doing so closely. And then the third thing, which I think is vital, working with your advisor and making sure that you're matching the risks to the time horizon, right? And we've heard it before, but just reiterating, like if you need the money within 12 months, some short-term window, might not be the best time to be taking equity risk with it. If you don't need it for years, then your big mistake is letting the news, the fear, and everything play into it, and kind of overriding that blueprint. So the message I would say is definitely stay diversified, stay intentional, and don't let your behavioral biases, the headlines, kind of hijack the process. The blueprint's important. And so with that, I'll hand it back to you, Jasmine, because throughout all of this, we were weaving in kind of our own insights. And hopefully we did a good job demonstrating how they interplay with each other and how we're building portfolios.
Great. So as we close, the key takeaway from today's webinar is straightforward, but important. Markets are evolving, not ending. The US economy remains on solid footing, and both fiscal and monetary policies are becoming more predictable. At the same time, geopolitical risks remain in the background, and US equities are slightly more expensive than in the past. So, in this phase of the cycle, we expect returns to be driven less by broad market exposure and more by careful positioning, diversification, and thoughtful portfolio construction. Last year's surge rewarded conviction. This period ahead is more likely to reward balance, as we said, across asset classes, geographies, and sectors. So thank you for spending time with us today. We appreciate your trust and engagement. And we'll now open it up for questions. If you want to ask a question, please click on the top where there's the Q&A button. We'll start with some pre-submitted questions. So the first question will go to Seth. What strategies do you recommend for broadening portfolio exposure, both within AI-related opportunities and across sectors that lie outside of AI?
Yeah, that's a great question. So if you already have a diversified portfolio, you likely have several levers to broaden exposure without making one big bet. So for AI, your large cap domestic growth manager should give you exposure to semiconductors and AI infrastructure, the headline AI names. But beyond that, you can balance this with parts of the economy driven by different factors and styles. So for example, value-oriented stocks, small and mid caps, and international equities can participate in growth, but aren't all tied to the same AI narrative. So Jasmine, I think the main idea here is pretty simple. You want to stay diversified and you want to avoid heavy concentration in any one theme. And that really helps you capture upside while keeping risk more manageable.
Great. Thank you, Seth. We have a question regarding refinancing. This one will go to Jim. A lower financing rates approaching, and how soon will we see this impact on mortgages, especially refinancing?
Gotcha. So sometimes I think people, when investors see that the Federal Reserve is cutting rates, they initially anticipate your mortgage rates to come down as well, and that's not always the case. I mean, I would probably reflect more on the 10-year U.S. Treasury yield. That seems to be a better benchmark for, say, a 30-year fixed rate mortgage. And unfortunately, although Fed funds came down 75 basis points towards the end of the year, the 10-year Treasury traded in somewhat of a tight range between 4% to 4.2 in the last 4 months of 2025. And so when I think about, where can refinancing rates, how can they materially come down, you would probably need to have a material shift lower in the 10-year Treasury yield. And we're expecting it to head lower, but materially and the impact to refinancings, we'll have to take a closer look there. The one thing that's acting as a somewhat of a headwind to refinancing, when you think about where mortgage rates have been over the past 5 to 7 years, there's a lot of homeowners out there that have locked in very low mortgage rates. So that's going to be a tough hurdle to overcome, but something that we're monitoring.
All right, thanks, Jim. Another interesting question on private equity. So it goes to Ivan. Private equity is increasingly raising funds via affiliated firms selling insurance-based products like annuities. And they're turning also to new firms for debt ratings, possibly stretching old norms for better ratings. How would more collapses in private equity impact public markets? I think the person asked the question also suggested a recent FT article.
So it's a great observation and great question. Thank you. More collapses in the private equity sector could impact public markets. First of all, through increased volatility and potential systemic risk. The impact would likely manifest in several interconnected ways, primarily through the insurance sector, credit markets, and real economy, rather than direct stock market crash. So the key impacts on public markets that come to mind are financial system instability. The most significant risk is the potential for systemic instability due to the close links across the financial system. If large private equity firms, which accumulated billions, or in case of Blackstone, over $1 trillion now, or their portfolio companies fail, the losses could spread quickly to banks and other financial institutions that had provided loans to hold their debt. And as it was correctly pointed out, private equity firms are heavily invested in life and annuity insurers, using their premiums to fund illiquid private assets. A wave of private equity collapses could lead to massive write-downs in these investments, potentially causing a liquidity crisis for the insurers. And that might leave policy holders vulnerable and could trigger a broader crisis of confidence in the insurance sector, which holds trillions in assets. I believe the US insurance industry alone holds nearly 10 trillion in cash and investment assets. So credit market shocks, private equity firms rely heavily on that. That's the blood of their deal making. A wave of failures would lead to a spike in corporate defaults, particularly among highly leveraged corporations. In bond markets, widespread defaults would significantly impact public and private credit markets, causing bond prices to drop and borrowing costs to rise to other companies. And this could freeze up the debt markets, making it harder to all firms to access capital. And debt ratings, the practice of using affiliated firms for favorable debt ratings could exacerbate the problem. And when actual losses materialize, the sudden sharp downturn, re-rating of debt could trigger market panic. And finally, the economy slowdown. Public equity-backed company bankruptcies often lead to significant job losses and business closures, which in turn hurt suppliers and local economies. And the large number of such events could reduce consumer spending and aggregate investment, leading to broader, protracted economic slowdown that would negatively affect public market performance. I hope I answered the question.
Okay. All right. Thanks, Ivan. A question on methodology and process. I'll let Andrew be our spokesperson. What resources do you rely on developing market outlooks and strategic planning?
Yeah, so hit on this a little bit in the macro overview as far as like risks to that global growth framework. The big ones that investors are going to grapple with and then make capital allocation decisions based on is really growth and inflation. And so we try to, from the macro standpoint, wrap our head around where those headed. But as far as like resources and data that we're looking at, it's the same thing that central banks are looking at, right? The high frequency data, whether it's labor market data, housing data, consumer data, and then just putting that all together and trying to figure out, okay, based on the incoming data, what does that do to our base case? Where does that tilt the balance of risks? And our team has definitely taken a hard look, and I think we pride ourselves, right, in understanding that the world isn't binary. It's not black and white. And so we want to build portfolios that can endure and withstand uncertainty. And so with that, we're constantly asking ourselves, what could we be missing? What's the downside? What's the upside? What's our base? And maybe the probabilities around that. And so that's really, the framework or the methodology that we're using across every sub-asset class, and then ultimately using that to guide capital asset allocation decisions.
Great, great. Final question, maybe I'll take this one. Discussion of recommended mix of investments in 2026 for couple in their mid-70s with 1.2 million in RIAs with monthly withdrawals totaling 5,000 and combined Social Security income of $5,000. A very specific scenario. I would recommend whoever is asking that question get in touch with our financial planner as well as our financial advisors so they can analyze your own specific scenario and decided on which one of the goal-based multi-asset portfolio you should put your money in. So this is really my plug for our colleagues out there doing financial planning and financial advisory. All right, no additional questions from the audience. That's great. Feel free to reach out if we can be of help. Wishing everyone a very successful 2026. Thanks for your participation. Thank you.